If you have money sitting in Chase Bank of America or Wells Fargo right now, stop what you're doing because there is something happening inside the American banking system that most people are sleepwalking past. This video is about exactly that. What's really going on with your money at the big three banks in 2026? How much of it is actually protected? How much you're quietly bleeding every single month without noticing? And what you need to do in the next few days to make sure you're not the next person blindsided by a problem they never saw coming. I'm not here to manufacture fear for clicks. I'm here because millions of Americans are parking their life savings in accounts they haven't looked at critically in years, coasting on the assumption that because the app opens and the lights are on, everything underneath is fine. That assumption is exactly how people get hurt. So before we go any further, hit subscribe, hit that bell, because this channel exists to tell you what's happening to your money in plain language before it costs you, not after. Let's start with the number nobody explains to you clearly, and it's the most important number in this entire conversation. $250,000. That's the ceiling on what the FDIC, the Federal Deposit Insurance Corporation, will guarantee per depositor, per bank, per ownership category. Sounds simple. It is not simple in practice, and that gap between how simple it sounds and how confusing it actually is has cost people real money. Here's the trap. If you've got $300,000 split between a checking account and a savings account at the same bank, under the same name, in the same ownership category, you are not fully covered. Only the first $250,000 combined is insured. Everything above that line is exposed if that bank ever goes down. Now I want you to actually sit with that for a second instead of letting it wash over you like background noise. Because this is the entire point of this video. Do you know, right now, without guessing, how much money you personally have sitting at each of these institutions? Do you know what ownership category those accounts fall under? Individual, joint, retirement. Because here's what the banking industry will never volunteer to you. You can legally protect far more than $250,000 at a single bank by structuring your accounts correctly. A married couple using a single account, a joint account, and a retirement account at the same institution can realistically protect over $1 million, fully insured, fully legal, completely ignored by most people, because nobody at the bank is incentivized to walk you through it. Banks are not sitting you down to explain how to maximize your protection. That's not their job in their mind. And it's definitely not their profit motive. It's your job to know it. And most people simply don't, because nobody ever forced the conversation. That blind spot, not knowing your exposure, not knowing your categories, is the single most common and most fixable vulnerability sitting inside millions of American bank accounts right now. It's not exotic. It's not complicated once you understand it. It's just information that never gets handed to you unless you go looking for it yourself. And that right there tells you everything about whose interests the current system is actually built around. Now let's talk about junk fees, because this is where the big banks have been dragged, kicking and screaming, into changing their behavior, not out of generosity, but because regulators finally started applying real pressure. Overdraft charges, surprise maintenance fees, non-sufficient funds penalties that historically drained billions of dollars a year out of American consumers, a few dollars at a time, spread across millions of people who never even noticed the bleeding. That's not an accident. That's a business model. Under regulatory heat, some of these institutions have cut overdraft fees, some have eliminated certain charges outright, and others have quietly restructured how those fees function in ways that are not exactly front-page news. Here's the question that should be bothering you right now. Has your bank changed its fee structure recently? And if it has, do you actually understand what the new rules are? Because I promise you, nobody is calling you on the phone to walk you through it personally. What actually happens is a notice gets buried in an email, you skim for 4 seconds, or a paragraph gets tucked into a statement you never opened past the balance line, and then, months later, your account dips a little lower than expected, and you find out the hard way that the rules changed underneath you without your permission or your awareness. This is not conspiracy thinking. This is how these institutions have operated for decades. Comply with the letter of disclosure law while doing everything possible to make sure you never actually absorb the disclosure. So here's what I want you to do, and I mean literally today, not eventually. Pull up the actual fee schedule for your checking and savings accounts. Not the marketing page with the friendly graphics. The real document. Read what triggers a fee, how much it costs, and whether that's changed since the last time you checked. Because I bet real money, most of you watching this, have never. Read that document even once since you opened the account. Let's talk about the interest rate con, because this is where the scale of what you're losing becomes genuinely staggering once you run the numbers instead of just feeling vaguely annoyed about it. Savings accounts at the big three banks are notorious for paying you next to nothing, a fraction of a percent, while those same banks turn around and lend your deposits out at dramatically higher rates, pocketing the spread as pure profit. This has always been true. It is more painful right now than it's been in years, because the gap between what a traditional big bank pays you and what's available elsewhere has widened dramatically. Online banks and credit unions have been offering savings rates multiple times higher than the standard offering at Chase, Bank of America, or Wells Fargo. So sit with this math for a second. $20,000 sitting in a standard big bank savings account earning a sliver of a percent versus that same $20,000 sitting in a high-yield account earning several percentage points more over a single year. That gap is real money. Over 5 years, especially if you're still contributing, that gap can stretch into the thousands. That's not a rounding error. That's a vacation. That's an emergency fund. That's a down payment you left on the table because moving your money felt like too much of a hassle. And before you go on with your day, this is exactly the moment to hit that subscribe button and turn on notifications. Because I break down these gaps, the fees, the rates, the fine print nobody reads every single week. And you deserve to know what your money is actually doing for you or to you. Here's the psychological trap underneath all of this. Big banks have spent decades building brand trust through advertising and branches on every corner. And that trust is not misplaced when it comes to the safety of your deposits. Because these are heavily regulated, heavily insured institutions. But trust in safety and trust in value are two completely different things. And confusing them is exactly what's costing you money. A bank can be perfectly safe and still be a genuinely bad place to park large amounts of cash if it's paying you next to nothing, while comparably safe, comparably insured, alternatives are paying meaningfully more. Separating those two ideas, safety and value, is one of the most financially liberating realizations you can have, because it strips away the emotional comfort of familiarity and forces you to look at the actual math sitting in front of you. Now let's get into something that should genuinely alarm you, because it's not about fees or interest rates. It's about criminals actively hunting people through the trust these big banks have built. Fraud targeting customers of major institutions has exploded, and it's exploded specifically because these banks are so large and so recognizable that they've become the #1 disguise scammers reach for. Fake text messages claiming to be your bank's fraud department, phone calls that spoof the real customer service number so it looks exactly like your bank is calling, emails formatted with real logos and real-sounding language, asking you to verify your identity or confirm a transaction by clicking a link or reading back a code. Here's the question you need to answer honestly. If you got a text right now that looked exactly like it came from your bank, warning you about suspicious activity and asking you to click a link, would you actually know for certain it was fake? Be honest with yourself, because these scams have gotten sophisticated enough to fool smart, careful people every single day. Here's the one rule that should be permanently burned into your memory. No legitimate bank will ever ask you to read a one-time verification code back to them over the phone or by text, ever. If that happens, it is a scam. Every single time, no exceptions, full stop. Understand the mechanics because that's your actual defense. It typically starts with a text that looked completely legitimate, sometimes even landing in the same message thread as real alerts you've received before. Because scammers can spoof sender information to slot right into that history. The message claims a suspicious charge, a locked account, a login from an unfamiliar device, manufactured urgency, because urgency is the entire weapon. A calm person who takes 30 seconds to think usually catches it. A panicked person usually doesn't click the link. You land on a fake page that's pixel for pixel, identical to your real bank's login. The moment you type in your credentials, they're gone. In the advanced version, a scammer calls you directly afterward, using what you just typed to sound convincingly official, and walks you through reading back a one-time passcode that just hit your phone. That code is the last lock on the door. Read it out loud, and the door swings open. So every time your phone buzzes with an urgent bank alert, ask yourself, am I reacting out of panic? Or am I verifying this independently? The safest move, every single time, is to ignore the link entirely, open your banking app directly, or call the number printed on the back of your physical card. A real alert will still be sitting there when you check it on your own terms. A fake one depends entirely on you never taking that extra step. Let's talk structure, because there's a piece of this system that doesn't get discussed enough in mainstream financial coverage. Chase, Bank of America, and Wells Fargo are classified as systemically important financial institutions, the formal version of what people casually call too big to fail. That designation exists because regulators know that if one of these banks hit serious trouble, the shockwaves would rip through the entire economy, not just their own customers. On one hand, that means more oversight, more stress testing, more regulatory scrutiny than smaller banks face, a genuine layer of protection smaller institutions don't get to the same degree. On the other hand, it means that when problems do surface at this level, they tend to be systemic rather than contained, hitting the whole financial system instead of staying isolated in one town. So the real question isn't whether your specific bank is about to collapse tomorrow. That kind of fear prediction isn't something anyone can honestly hand you. The real question is whether you personally are positioned to be fine, regardless of what happens at the institutional level, and that's something entirely within your control. And while we're talking about institutional behavior, let's talk about customer service, because this is where a lot of documented frustration has piled up. As these banks push harder into digital operations and thin out in-person branch staffing, customers report longer waits, more automated phone mazes, and real difficulty reaching an actual human being when something goes wrong. If your card freezes while you're traveling, if a transaction error hits your account, if you need to dispute a charge, how confident are you, honestly, that it gets resolved fast? Test it before you need it. Call your bank's customer service line today, not because anything's wrong, just to see how long it takes to reach a real person. If it takes 45 minutes and 3 automated menus to ask a simple question, that tells you exactly what to expect the day you actually have an emergency. And understand this too, when a bank hands you a checking account with no monthly fee, that account isn't free to operate. It's monetized somewhere else. Overdraft charges, interchange fees charged to merchants every time you swipe, the spread between what they pay you in interest and what they earn lending your deposits elsewhere. None of that is sinister by itself. It's simply how commercial banking works as a business, but understanding it reframes the relationship. You are not just a customer. You are also, in a very real sense, the funding source and the product. That distinction should change how you evaluate every account you hold. So here's what you actually do with everything I just laid out. Starting today, not next week, log into every account at every institution where you keep money and take a genuine inventory. Real balances, real ownership categories, real total exposure at each bank relative to that $250,000 threshold. If any single bank shows a combined balance above that line in the same ownership category, that's your signal to either restructure how those accounts are titled or move the excess to a second insured institution. Second, pull the actual fee schedule, the real document, and know exactly what triggers a charge and how much it costs you. Third, compare your current savings rate against what high-yield accounts and credit unions are actually offering right now, and calculate honestly what idle money sitting at a low rate has cost you over the past year. Fourth, save your bank's real customer service number directly from the back of your card or the official website, not from a text, not from an email, so you're never in a position where you can't tell a scam from the real thing. Fifth, if you're carrying savings above the insured limit at one bank, take the time this week to fix it, not eventually. This week. None of this requires panic. None of it requires closing accounts or blowing up your financial life. It requires 15 or 20 minutes of actually looking at what you already have instead of assuming it's fine, because it's always seemed fine. Most financial damage doesn't come from some sudden, catastrophic event. It comes slowly and quietly, from small gaps in knowledge that compound over months and years. A fee you never noticed, a rate you never questioned, a coverage limit you assumed covered you when it didn't, a scam text you almost fell for on a rushed morning. Closing those gaps before they cost you anything is the entire point of everything I just walked you through. So here's my real question for you before you go. Are you going to be someone who actually logs in today and checks? Or are you going to close this video and forget every word of it in 5 minutes? I hope it's the first one, because the people who take 15 minutes now to understand their own money are always standing on firmer ground than the people who wait until a crisis forces them to pay attention. If this actually helped, you see something you didn't see before, hit that like button. It genuinely helps this channel reach more people who need to hear it. Drop a comment and tell me which bank you use and whether you actually knew your real FDIC coverage before this video. I read every single one. And if you haven't already, subscribe and turn on notifications, because I'm going to keep breaking down exactly what's happening to your money, your accounts, and this financial system in plain, honest language. No fear-mongering, no hype, just what you actually need to protect yourself Take care of your money, and I'll see you in the next one.